Hello. Hello, hello, hello.
COVID-19 era. Thank you for joining us tonight. So can you move to the next slide? So IOS, so my name is Elena Hangsham. I'm one of the financial coaches and housing counselor here. My colleague Patricia Berhow and Kit Patel joining us tonight. They will be presenting for tonight's webinar. So we would like to introduce what is IOS. IOS was founded in 1981. We're a community development environmental organization. We're based in Trenton, New Jersey. And our mission is to foster self-reliant families and healthy and sustainable community. We design and develop effective services that support this mission and share what we learn with others who can make a difference. So IOS Financial Solutions is one of the part of IOS. It was created because there was a need for it. Can we move to the next slide? Okay, IOS Financial, personal financial services designed to assist moderate and low income consumer in meeting everyday financial challenges. So we talk about budgeting, credit, debt, saving, and home ownership. So please contact us if you have, one-to-one assistance. So let's start with tonight's webinar.
Thanks, Elena. Hi, everybody. My name is Patricia Berhow, as Elena said, one of the financial coaches and housing counselors at IOS. The tech is a little weird. I can't see anything other than the screen, so that's going to freak me out a little bit, but I'm just going to hope that, somebody would tell me if I have something on my teeth or something. Okay. So we're doing both credit and debt in tonight's presentation. So I'm going to start us off and probably use up more time than I should going through the credit piece of things, which of course, both of these are connected. Kit will pick things up afterward, talking more specifically about debt, but of course they intermingle. As you can see right here, right? Credit and debt are certainly connected. When it comes to credit, it really comes down to a main issue, which is people that you are at, creditors and others are asking, what kind of reputation do you have with regards to accumulating and paying back debt? Okay. If they're asking based on this person's, essentially we can think of it as your financial reputation. Is this somebody I want to do business with? Should I take this risk? And if I do take that risk, what should I charge these people, this person, so that I know that I'm going to make some money on the deal? Okay. They're using a credit score in it essentially as a way of sizing you up. And a credit score, not unlike a grade in school, right? That's basically what it boils down to. It's a 3-digit figure. People are pretty well familiar these days with how, we all see credit and know about our credit a lot more than we used to. But in terms of that grade that we're talking about, there's all ranges, right? The upper end is about an 850, although I don't think I've ever seen an actual 850, down into the 300s. I mean, essentially, there's not great agreement about what's considered excellent or, very bad versus poor or something, as you can see, in this slide. But for the most part, you want to be at minimum in the 600s. If you're below that, you definitely want to move things up. For example, to buy a house, you typically are going to look to get a 620, a 640, depends on what's happening at the time. And of course, the better your credit, the better off you'll be. There's no point in getting beyond a certain level. A 740 is usually considered, sort of the threshold for getting all good deals and whatnot after that. But to be honest, if you've got an 810 or a 790, there's no real difference, at least not in things that we see. All right, so who creates these credit reports? Again, I think people are really well familiar these days. It's Equifax, Experian, and TransUnion. One is not better than the other or anything of that nature. And the creditor that you go to or who's ever looking at the report, they can use any one they choose to, or all three. So their business is essentially to collect the information and to distribute it to people who have an interest, a legitimate interest in seeing that report. We get a lot of questions about, different scores, because of course these days people do see their credit and it can be, wildly off. Part of that is because of these three different bureaus, but the other piece of that is because there actually also are different scores. Mostly when people talk about a credit score, they're talking about a FICO score, right? FICO stands for the Fair Isaac Company, Fair Isaac Comparison, actually, and the company that it's named after. There's also a Vantage score, but it's far less used, okay? Even within FICO, it's not like you just have one FICO credit score. They have many, many different models, and you don't know which one the lender or whoever you're dealing with is looking at. They're all going to be similar, but they're not exactly the same. We'll talk in a moment about the components a little bit more. But the 6 major different FICO scores, there's the generic, there's a mortgage one, a car one, a bank card one, an installment, and a personal finance loan one. So sometimes people get agitated, like, my Credit Karma gave me this, and then when I went to get a mortgage, they told me something else. They're just because there are different scores, but they shouldn't be that far apart, across within one particular bureau. All right. Briefly, why does any of this matter? Who really cares? Obviously, credit is used for a lot of different things. Everybody knows, credit cards, buying a car, getting loans, things like that. So you'll save money. The better your credit, the better rates, and the more options you're going to have as well. But it's also in other things like hiring, when you go for a job. Auto insurance rates is a really big one. You can actually be charged a lot more in your premium if you have poor credit. So that's another reason that you want to get your credit into shape if you can. Before I go any further with that, I really do want to emphasize the if you can part, because as we said, given the situation that, many people are finding themselves in right now with COVID and, the economy, maybe right now is not the time to really care very much about your credit, or it's not a top priority, right? If you're dealing with a moment where you've got very limited income, what's best for your credit report is not the priority. It's a consideration, and that's why we want to make sure people have the information so they can think about it either for now or for the future when it is the right time for you to work on your credit. One of the things, I don't like a lot of stuff about credit, but one thing I will say in its defense is that it's not permanent. No matter how bad it is, it can get better and will get better over time with the right opportunity, to manage your money perhaps differently than you were able to or did in the past. Okay, I'm going to zoom through a little bit faster here now on some of this. Everybody's seen their credit report these days, typically, so you know what's on there. There's a bunch of personal information, name, social security. Be aware of what you do with your report if it shows the full social security. And then it's really all this information about old present accounts and old accounts. Inquiries are on there when you generate one or companies do, and we'll talk more about that in a moment. And public records. Mostly what we see in terms of public records on reports these days is bankruptcies, or perhaps things like unpaid child support, possibly. Depends on the agency and how to get in touch with them. Some ways, more importantly, is some of the things to think about what you're not going to see on your credit report. Mostly you don't see things like rent payments, unless perhaps it went to a collection agency, then it may show up. Same thing with utility bills. You might be paying your bills on time every month. Generally, that does not show on your credit report. We'll talk about an exception to that in just a moment, because that's a new thing that sometimes people can have that show. But mostly utility bills don't show unless it goes bad. If it goes bad and then you wind up in collection, then it's going to show up on your report. Same with sort of bank overdraft, things like that. Some things recent times that you may or may not be aware of is just in the last couple of years, there've been some changes, tax liens and judgments, things like that. You do not see them on credit reports anymore. That does not mean you don't have them and that you don't owe that money. And Kit will talk a little bit more about that later. We've included a link here that you can go to see if there are any judgments as a search. If you don't get it from the webinar tonight, you can contact us afterward. This is being recorded. I hope so. It's supposed to be. And that'll be available later on, or you can contact us about any of this information afterward. We're happy to talk to you one-on-one or send us an email, and we'll have our information available later. And paid medical collections, that is something that does not show up on your credit report once it's paid. So medical debt is a little different like that. All right. But what are the main components, right? We said it's like kind of like having a grade in school. Well, just like a grade in school, not everything counts the same, right? So this is FICO's chart. Vantage score is just a little bit different, but essentially it's the same kind of components. All right, so what are we looking at? The different issues are, we see right here, 35% of your score is based on payment history, 30% on amounts owed. Right there, 65% of your grade is just based on those two things. So we'll talk about what that means and how to fix it. Other things that count, type of credit that you have, asking for new credit, and also your credit history, how long have you been around? So let's go through each. All right, the biggest one, payment history. Do you pay on time? Oh my God, they care about this so much. This is like the biggest thing that creditors care about, as you can see, 35%. Have you been late? If you've been late, how late? Are we talking 30 days late, 60 days late, 90 days late? How many different accounts? All of that matters, and all of that gets calculated in terms of coming up with your score. And obviously, if things have gone to collection or charge off, that's going to be a big drain on your score without question. Amounts owed. It's not really the way to think about this. Mostly what this has to do with is when it comes to credit card debt, it's what is the proportion of credit that you're using relative to what's available to you. So if you have a card that has $1,000 limit, do you owe $999 or $1,001? Essentially, are you maxed out, or are you just using a smaller amount of what's available to you? They care about that, okay? And it varies. If you have $30,000 of student loan debt, they do understand that that's a specific kind of a loan, and that's taken into consideration. It's treated slightly differently. As far as your credit history, how long have you been around? Do you have much of a track record for the creditors to look at? That factors into whether or not you're going to have a positive credit or not. New credit discount, this is inquiries. Okay, so here is where every time you go to open an account and you're asking for new credit, that's put into your credit report. All of that information is in there. If you have new inquiries, how many have you got? How recent have they happened? All of that is going to affect your score. People often ask about, soft pulls, like if you check your own credit, that is not going to count against you. And if you go to like a nonprofit organization like ISLES, you know, especially if you're just trying to understand your situation, that would be counted as a soft pull. You can always ask if you're unsure in any given situation of how something is going to be viewed. One thing that we do like to mention is there's also a difference in terms of when people are what's called rate shopping. So the algorithm that's used to come up with your credit score, they recognize when someone's looking for a mortgage or to get an auto loan, something like that, that you should be shopping around. So instead of getting dinged every one time you make a new credit inquiry, they will treat that as one event, one credit inquiry, if it's done within a short period of time. I see a lot of misinformation, even from the credit bureaus, or I should say, contradictory information from the credit bureau sometimes about how long that window is. Just before this, I did some additional homework to look on websites. I saw one that literally FICO that said a short period of time. I don't know what that's supposed to mean. I saw 14 days. I also saw 45 days from one of the credit bureaus as being that window. So I can't tell you 100%, but it's at least 2 weeks. I've never seen anybody refer to it as less than a 2-week window. And finally, what makes up your score is this types of credit. So, you know, it's kind of, this is one that I think there's not a whole lot to do about. It's supposed to be that, you know, if you're somebody who has some sort of mix of things, you know, maybe you have a mortgage and you have a car loan and you have a couple of credit cards, you know, as opposed to just, you know, some other arrangement of a few cards. I've seen people with, you know, just 2 store cards and a small loan and they have great credit. So I'm not sure exactly how that works. It's not something for people to focus on. All right, so now the question really is, knowing that, the question really is, so how do we improve your score if that's something you're looking to do? What should you do? Well, my top takeaways on this essentially boils down to, number one, you got to be in it to win it. So you have to have credit, right? Sometimes people don't have any credit because whatever, you're young, you're new to the country, maybe you had a bad experience with before and you just think I'm better off keeping my money straight without any credit cards and whatnot. Yeah, the problem with that is if you don't have any credit, then you can't do the next thing, which is number 2, show off. You have to show these lenders how good you are at doing the right thing when it comes to credit. And what does that mean? That means paying on time, not using too much of it, and not asking for too much of it, okay? Now, with the don't use too much, this is the don't max out your cards, right? Guess what? Because that just makes you kind of look desperate. They're looking at you and they're wondering, why is she charging up everything? Why is she maxed out all over town? You don't look like a very good risk, so that's going to lower your score. Same thing if you keep asking for loans, right? I mean, if you do that, whatever, with your family or friends, you kind of look desperate and they start to think like, I might not get this money back if I loan it to them. So you've got to have some credit to show off how good you are at not using too much of it and not asking for too much of it. That's the inquiries part. Okay, so it's a little tricky. The next thing that really you need to do to have a good credit score is you have to tell a good story. So a lot of times when people have had bad credit, they're focused on dealing with the bad stuff that's on there, maybe the collections and things like that. And that's all well and good, and that may be part of a credit strategy. But if the only story on there is a negative one, even if it's an old story, you have to start to crowd out that bad story and information with something new and positive. Okay, so it can't just be about dealing with the old. You have to do something today that shows that you're doing the right thing when it comes to money. So again, you've got to have that opportunity now to show off. Yep. All right, so let's think a little bit more specifically about what are you going to do to improve your credit score. The question you'll need to ask yourself, there's not a one size fits all for this. It depends on what is the problem, right? You have to identify the problem before you can come up with a solution. So first things first, of course, you want to take a look at your credit. Again, these days, this is much more prevalent. People tend to have a Credit Karma account, or through maybe if you have a credit account, you get CreditWise or, one of those things. That's great. You can use those. You're also entitled, everybody, through annualcreditreport.com, this particular site, and that's the phone number. Everybody in a normal year is entitled to one free copy of your credit report from each of the 3 bureaus. Okay, so you go through that website and you can request it from each bureau. Now, because of COVID and people's, financial situation, it's actually the case that you can request one every week for free from each of the bureaus going through that annualcreditreport.com. That's going to be the case as of now until April of 2020. You will not see your score when you go through annual credit report, but you will see all of the information that's on your report, okay? So you can go to some of those other free sites, Credit Karma, that kind of thing, if you want to see your score and get your report, though, through annual credit report. All right, so what do you do to dispute your thing? It is true, your first thing you want to do is look through your report and see if there's anything inaccurate. If you paid something and that's not reflected there, absolutely. You go right through the online is usually the easiest way to do it now. There's a whole process you can walk right through. The credit bureaus then they have a short period of time, 30 days, to go to the creditor, find out what the story is, and then they need to either remove it or let you know if it's been substantiated. I wouldn't get too hung up, especially if it's small things like, oh, I lived in apartment 3A and they wrote 3B, unless that's an indication of an identity theft situation, you think, then you certainly want to, pursue that. But otherwise, you can make a legitimate claim if you have one about any inaccuracies. Absolutely. All right. So what if your problem is that you don't really have much credit? You're not, you haven't had a chance to show off. You need that opportunity. So you do want to open 2 or 3 accounts in order to show off. Remember, that's the reason you're doing it. And how you go about that initially, you could try to get a secured credit card. As many people are familiar with them now, it kind of works just like a, security deposit on an apartment. You get approved for the card, you'll give the lender like $300 maybe, and they give you a card that has that much credit on it. You're allowed to charge up to that, okay? Maybe a student card might be another option. You can go online and compare different cards, look at their fees and things like that on some of these sites listed here, credit.com, bankrate.com, etc. You could get a credit builder loan. Typically it's credit unions that offer these, not so much the bigger banks. It might be just a small loan of $500 that you pay back over the course of a year. And really you're getting it not because you necessarily need $500, but as now you can show off how good you're doing at paying back your debt every single month on time, okay? Another thing that people can do when you have little credit is perhaps become an authorized user on somebody's account. So it could be your spouse, your parent, your aunt, whoever it may be. They don't have to actually give you the card. They can make you an authorized user on their account. And then their good credit behavior and history actually starts to benefit you on your report. So that can be effective. Word of warning, be sure that the person that you're requesting that from has actually a good record with their credit in all the ways that we're talking about, so that's something you want to watch. But like I said, they don't have to give you the actual card. They can just put you on as an authorized user and not let you even have a card. Okay. All right, I'm going to move right along here. So like I said before, though, if you're going to show off, if you're going to get these cards just so that you can show off, you better do it the right way. By which I mean, don't use too much of it, right? You can't be maxed out. creditors, for credit report purposes, credit score purposes, they want to see you having the credit card, but only using maybe 30% of what's available to you, right? Or maybe even just like 10% of what's available to you. That's what's, you know, when you're really trying to have great credit, if you can keep it under 10%, that's ideal. So in an example, if you had a $300 limit on a secured credit card, that means to keep it under 30%, not using more than $90 would be the balance on that card at any point. Or if you want to go for the 10%, don't use more than $30, right? Pay it on time every single time. I always give people the tip, you know, it's like you get the card, and if you have a car, go put $29 worth of gas in it and then put the card away. And then when the bill comes, you pay them all $29. You do not need to carry a balance. Pay them off the money, and then the next month, just do the same thing again. So you're keeping your limit low, and you're showing off at how good you are at paying on time every time. Okay. Oh, sorry, I keep going the wrong way with this. Okay, this is a new thing-ish, this Experian Boost. Essentially, now there are some ways for people to demonstrate alternative credit scoring. You can demonstrate good payment behavior with other bills. Remember how I said that, you know, like your cell phone bill and things like that don't show up unless it's bad? Well, Experian Boost is one, probably the most popular now with one of the main bureaus, where you can sign up for this service. And what they do is you open an Experian account, it's free. And they will look through, they have to have access to your banking record so that they can see things you've paid through there. If you pay your cell phone, like, I don't know, with cash or whatever somehow, or a other kind of a card, then it's not going to work. It has to be through the bank where they can see it. They will give you credit for good credit behavior. When you were late, they don't count that. But if they can find multiples of positive behavior, like I said, with things like your cell phone, now I think they're doing Netflix as well. If you have a Netflix account that you pay on time every month, that might help improve your score. So it really is, you know, if you don't mind opening that account and giving that information, Experian can't do anything with your bank account. You're just letting them see what the history on there is. For about 24 months back, they'll look. So people can see their scores go up, absolutely, with this. You know, as far as the downside, it's not going to impact your TransUnion or your Equifax reports, so you don't know which ones a lender might look at. And if it's an older scoring model, you know, they keep on having newer scoring models. Old ones are not going to show any evidence of this. So something to think about. Okay. And how am I doing on time here? Yeah, I should be wrapping up soon. Okay, what about if your problem is that your credit utilization is too high? This is the thing where we said you're kind of maxed out. Well, as we just said, you really then, the option is to pay down the balances, do better in terms of your revolving debt so that you're down to 30% or 10% of what you owe. You know, really, ideally, you want to pay it off and not just move it around and get a different loan. As of January of this past year, they've actually changed the models to kind of capture that, because it used to be sometimes people would have, like, they'd be maxed out on their credit cards and then they'd take a personal loan, move the debt over there. So now their credit accounts, you know, show that they have all this space, you know, and their limit. You know, they're not utilizing much of what's available. They've actually changed some of the models now to try to capture that, because they think that that's not a particularly healthy financial strategy. So it may work. It's also not sound from a financial perspective. You really, you know, you want to find some way. I mean, it may make sense with one lower cost loan. Kit's going to talk about that, but you know, as long as you can stick to it. And that's one of the downfalls when people move things over. They tend to just rack up credit debt again, unless they fix the problem. So really, you want to find that money. If there are some ways you can increase your income, can you reduce your expenses? You know, make a specific plan. If it's $3,000 you have to pay off and you're going to do it over how many months, 10 months, $300 a month, you know, etc. Be real specific about it. That's what they call these SMART plans, where people are specific and they pick measurable goals that are attainable, be realistic, etc. Sometimes you can sell stuff to, you know, raise that money. People do a lot of things with Craigslist or whatnot these days, or perhaps your tax refund will come in handy for that. What else? If your problem with your credit is that you have late payments that are on there, a history of late payments, that is a tough one in terms of a lot that you could do to correct it, because there isn't really much, you know, once it's on there, if it's accurate, it's not going to, for the most part, it's not going to go away. Essentially, you got to bide your time. And again, start doing better, start telling a better story. And over time, that old information will count less than the information that's going on today. That's going to get, so you want to crowd out that old story with a new one. And again, doing better going forward. How do you do that? You can maybe put some bills on auto pay. If you know you're going to pay your car payment no matter what, maybe that is one. Maybe you don't want to put all your bills that way, but you could do it for some. Set up bill pay reminders. You could create a system of doing twice a month bill paying. You know, this is the kind of thing where we as financial coaches, we're happy to sit down with people and come up with a plan that works for you. You know, not the same strategy works for everybody, so you really have to figure out what's good for you. Sometimes people really need to get ahead of the billing cycle. I talk to people sometimes and, you know, it's sort of like, oh, I paid it late because, you know, the payday moved around and, you know, a rent was late this time because I got paid not on the 1st, but the 5th. Okay, the problem is that you should have been probably using the pay from the 15th for your rent. You're kind of a little behind there. So you need to raise money to maybe change that cycle that you're in. All right, quick note, if you did make an arrangement during COVID with one of your creditors, they may do that if you were current before the pandemic thing set in. They should not be reporting you. You want to check your credit report and make sure that you are being correctly, you know, you're not being shown as late. If you have an arrangement with your creditor, they need to be making sure they're following that agreement. Collections, charge-offs, Kit's going to get into this a moment in terms of dealing with it and what you can do. What I will say about this is you do want to take a look at when those things, how long they've been on your report. It can be a little bit tricky. People ask all the time about, you know, when does it fall off my report? So the way the clock works for debt is from the time it goes bad. So in other words, if you had a credit card account and you stopped paying on it in whatever, January of this year, say 2020, that's the time that you stop making the payment. The clock starts ticking there, and it's 7 years. Sometimes they say 6 years and 180 days, but let's just say 7 years from then. That's when it falls off your credit. Okay. Now it may travel into a collection agency, and they have a different date that they put on, but the date of first delinquency, that's when that's when the clock starts ticking in terms of when it falls off. So again, you may think about that in your strategy for dealing with debt, at least from a credit perspective. If it's going to go away in 6 months, maybe that's not the credit issue you want to be focusing on. Okay, and let's see. Quick note about medical debt, that this is treated differently. They don't report it right away. There's a grace period now of 180 days. It's not counted as heavily as other things. And unlike other debts, when you remove, it does come off after you or the insurance pay. So if you have something that went to collections and it's medical debt, and then you pay it off with them, or even the insurance takes care of it, whatever, it will then disappear. Whereas the record that it existed ever normally stays on there if it's a different kind of collection debt. But if it's medical collection debt, it will go away completely, or it should. Okay, so again, something else to consider in terms of credit. All right, a couple of tips that we wanted to circle back to before I wrap up in just a moment here. People say this whole issue of being able to show off, well, you have to have it. So it's back to that, you got to be in it to win it. You have to have accounts to show how good you are at not using them. So you don't want to necessarily close unused accounts unless it's really bad for you. If you know that you and that credit card just don't get along and you are going to go into Macy's and charge stuff up, et cetera, and that's going to be bad for your budget, then maybe you do need to close that one. Or if it's costing you a lot, or, there are circumstances where you might want to just shut it down if you still have a few, but consider other options and maybe just use it every once in a while. Don't open too many new accounts. Every time you go into Old Navy and they offer you 10% off, you don't need to take that unless you really want the card. It's really something that you need or you want to do. Don't just willy-nilly have all these inquiries going on. Co-signing for others, this is a really tough one because, people, you have grown children and they're just getting started and they need a co-signer for a car loan. Unless you are willing or able to pay that bill or have some control where it's being paid, it can be, because you are just as responsible for that debt. And as I said before, do not carry debt just for the sake of carrying, because you think you have to for your credit. You don't. Don't expect things to change overnight. Some things happen faster than others. Like if your problem is that you have too much debt and you pay it down, you probably have a pretty quick response to that. But other things like being late, you have to sort of let time pass. And again, the old stuff has a reduced impact over time. The new positive information is going to help. So review your credit report, make a plan. Don't forget about the top takeaways. And, focus on your overall financial health. Got to be in it to win it, show up by doing the right thing, and tell a good story. And I think that is it from me. As I said, it took a little more time than I was supposed to, but such it is. And I'll pass things over to Kit, and hopefully we will be able to entertain some questions by the time we get to the end. I'm sorry, Kit, I always do that. But if we can't, everybody will have our contact information. Please get in touch with us. If you do have a question that we're unable to circle to, we will do it later. Thanks. Oh, you're muted.
There we go.
Yep.
Hi, everyone. I'm Kit. I'm a financial coach here at ISLES. Let's talk about debt. It's everyone's favorite subject. For everyone, the ultimate goal is obviously to be debt-free. But as we know, life happens, debt accumulates from our wants and needs. As a result, we need to understand the options available to us when debt starts to become heavy and unmanageable. These days, things can spiral out of control quickly. But there's good news. Creditors have never been so understanding, accommodating, and compromising. Next slide. Now, everyone's situation is different, so we need to think about debt logically instead of emotionally to determine what's a good fit for you. We should review credit reports. As Patricia mentioned previously, you can get a copy of your judgments no longer appear on credit reports. So there is a link, a government link here that will be provided to you where you can actually go to check to see if you have any tax debt or any judgments that that you're not aware of. So that's step one. Also, make a list of all your bills, even those that do not appear on the credit report or this particular database, right? Maybe you have some fresh medical bills or collection accounts that just started that haven't really shown up on your credit report. So basically, you got to create a budget. I mean, that's a whole nother webinar that we talk about how to create a budget, but you need to know what's coming in and what's going out. You should try to anticipate, future changes in income. Our situations are constantly changing. Things break down, water heaters, cars. We have to keep it all in the back of our mind while we're exploring our options. Even due to COVID, some parents have daycare expenses, or they may be expecting a reduce in income, or they may not have daycare expenses. Everyone's situation is so jumbled up right now. So, we got to hope for the best, but plan for the worst. Next slide. As Patricia mentioned, you can get a copy of your credit report from all three bureaus from annualcreditreport.com. I'm not going to really talk much about it, but you can get one for free from all three bureaus once a year. And due to COVID, I believe you can get more than one. Next slide. Now, as we're thinking about our debt logically, we should review our options in this order. Dealing with the original creditor. Next slide. Dealing with the original creditor. Usually when the debt is current or it's just slightly behind, you can call the creditor and explain to them your situation. They may put you on a payment plan, but they may also close that particular account so you don't dig yourself deeper into a hole. If you have good credit, you may be eligible to do a balance transfer, like a 0% balance transfer, but that does come with its cons as well. They may charge you a 2 to 3% fee on top of on that balance to transfer it. And there's a term. It's maybe 12 to 18 months. You have to create a plan to figure out a way to pay as much of that debt as you can within that term, so you don't get assessed interest. But usually there's a risk where as you transfer the balance, you have one card that's free now. You kind of forget about the card with the 0%, and you risk adding more debt to your situation. So you have to remember you still owe that money, and you don't want to double that debt load. Now, you can also apply for loans, such as consolidation loans with credit unions, peer-to-peer loans. They are very popular these days. I do not recommend them because they come with high interest. And again, you add the risk of adding more debt to your situation. Now, you could take a home equity loan. Maybe if you have a house, you could borrow against your equity. Right now, it seems like everybody has equity. You're hearing the housing market's booming and prices are going up, but we do not recommend you take a home equity loan to pay down some unsecured debt. You're adding the risk of adding more debt, and people usually end up recharging the credit cards. And you don't want to get in a situation where your situation completely changes and you no longer have enough equity in your house for real problems. You don't want to turn that unsecured debt into a secured debt. Now, we had a question from one of our attendees regarding 401ks. And the question was, is it a good option to take take a loan out from the 401k to pay off credit card debt? It really depends on everyone's situation. However, I do not believe it is a good option to do this because you add the risk of adding more debt. Usually people end up recharging the credit cards that they paid off, end up with double the debt load. We see this time and time again. In addition, if you leave that job for any reason, that loan may come due and it becomes a distribution that can be taxed. So there's a added risks there. You don't want to risk your retirement on unsecured debt. There are other ways to deal with this debt, such as a debt management plan. Next slide. Now, a debt management plan is an amazing plan. I've had so many customers who have had amazing success with this plan. Basically, it's geared mostly to credit card debt. People who are feeling, the debt load is feeling heavy. They have multiple payments. They're not able to make a dent on the balance, and they're just paying these minimum payments. A debt management plan will consolidate all those credit cards into one monthly payment. And you would pay this payment to the credit counseling agency, and they would disperse them to your creditors. You would still get bills in the mail showing that your balances are going down. And this plan is designed to get you out of debt within 4 to 5 years, which is amazing. If you were to do it on your own, it would take over 13 years probably to pay off your credit card debt just by paying minimum payments or a little extra here and there. Now, they will close your accounts. You may be allowed to leave out one if it's not affiliated with a bank that's in the program. There is a monthly service fee. It's a modest fee. You won't even feel it. They are a nonprofit, so they're not out there to make money off of you. Next slide. Now, when the debt starts to become unmanageable, a debt settlement is a good option. This is where the accounts have been sold to a collection agency. So once an account goes over 6 months of non-payment, usually the original creditor will sell this debt to a third-party collection agency, and they will be required to recover that particular debt from you. They may have bought that debt. If you have, for example, if you have a $2,000 debt with Citibank, they may have sold it to the collection agency for $700. And you have now the ability to negotiate directly with the collection agency for a lower amount. You could pay less than what you owe. But however, they require a lump sum payment, and you have to be ready to pay if you're going to negotiate with the creditor. So there are risks associated with that, such as if, for example, you may receive a 1099 from this collection agency because they consider the difference between what you owe and what you paid taxable income. But I guess that's a problem for another day. But at least you're taking care of your collection account. It's one less problem to worry about. And you need to get everything in writing because collection agencies are scrupulous. If you get it in writing, these days they'll just email you something. You could save it, and if you need to dispute it later, because sometimes things don't update on your credit report, at least you have it in writing. Next slide. So also when things become even more unmanageable and everything starts to pile up, probably you're at this point facing some type of bank levies, garnishments. Bankruptcy is something that people seek has a solution. There's 2 different types of bankruptcy. There's a Chapter 7, which is a complete liquidation, a Chapter 13, which is a reorganization, and there's a attorney fee associated with that, anywhere from $1,000 to $1,500. You'll go through bankruptcy counseling. They'll put you through a means test to determine which, bankruptcy is best fit for you. Usually people who have a Chapter 7, they don't have a house, a car, something of value, right? That can be liquidated to pay down the debt. Usually they will just wipe the slate clean and you can start over. Now, a Chapter 13, you have a home, you have a car, you have retirement funds that you can kind of tap into to pay down some of the debt, but you don't want to. So they will reorganize that debt for you where you pay a portion of it. Now, this is all discussed with the bankruptcy attorney. They'll break it down for you based on your particular situation. But bankruptcy isn't, people feel like it's a bad word, but it can be a relief, because once you file bankruptcy, you can start over. It's, after 2 years from your discharge, you can actually get a mortgage. 6 months after the discharge, you can start to apply for a credit card, a secure credit card, start to rebuild that habit. So when you're ready to, buy your next car or get your next house, you're going to have good credit, decent credit. I mean, you're not going to get the best rates, but over time, and good behavior, things will improve and you can always refinance. Next slide. So what happens if you don't pay your bills? Obviously, garnishments, bank levies, basically doesn't happen overnight, but they can garnish your wages up to 10. Each creditor can garnish up to 10% of your wages. So if you're receiving something in the mail from like a legal notice, you want to respond to that. Don't bury your head in the sand. You want to, be proactive, reach out to that creditor, try to make a deal with them to prevent it from going that far. You can, if it doesn't work out, that's fine too, because then you can actually show up to court, whether it's a Zoom meeting with the judge or in person. You can show up and you can tell them, you tried to do something, it didn't work out. They can't take blood from a stone. So some people are judgment proof though. If you have SSI, if you're receiving some kind of assistance, they can't file a judgment. They can't do any kind of bank levies. And now, if you have student loans and you fall behind on those, the government will definitely garnish your wages. They will absorb that tax refund if you are to receive one. What we recommend when you have student loans is really reach out to the lender, try to work out a forbearance, put them in forbearance, work out some kind of payment plan, because right now you cannot discharge student loan debt through bankruptcy. And obviously you'll have poor credit, right? But poor credit is it's temporary. As long as you do good, you have good behavior, paying your payments on time, moving forward from that moment on, you can start to improve your credit. It may take a little time, but you can always improve your credit. It just takes time. Next slide. So what do? Review your debts. Create a budget. You got to know what's coming in, what's going out. Consider all these options. Make a plan based on these options, and then put your plan into action. You can get a financial, we can help you. We can sit down with you. We can go over your credit. We can go over your budget. We can help you create a plan. But at the end of the day, it's up to you to implement that plan. Thank you. You can reach Patricia, Elena, myself for further questions. This is our contact information.
Thanks, Elena or Kit. There was one question I had seen earlier. So I just wanted to circle back. You had mentioned briefly, I'm trying to get my video back here. And yeah. Oh, here it comes. Okay. All right, there I am. There was a question that someone asked about, you mentioned in the bankruptcy, the issue of, cars and things like that. And just wanted to say a little bit more about that. It really does depend. It's not, someone can declare bankruptcy and they may very well be able to keep their car and the car payments that they're making if they wish to. Somebody I know who just a little while ago did a bankruptcy and he has a lease on a car, but he wanted to keep his car. That's how he gets to work. And, so that was deemed reasonable. And so even though he was able to liquidate the unsecured credit card debt, he was allowed to, in a Chapter 7, he was allowed to hang on to the car because he wanted to. Other people that we've worked with, like I said, the car, it's too much. It's part of the problem. So they may then wish to give it back and have that debt be part of the whole bankruptcy. So it depends on how that goes. You may very well be able to, especially like that. If it's your home, if it's your car, you need this for your livelihood, then that is typically something that is worked out. All right. I don't know. I think that was it. If there was other questions that you were able to see from there, Elena.
Yeah, there's a question. I answered some of the question, but there's a question. What happened to my credit score if I pay off my car loan?
It will probably go up over time.
Well, but I think the question's a good one, right? Because on the one hand, that's a great thing, right? You've paid off your car loan. But to my point earlier, like, hey, how do I show off now? But, so you're not going to be penalized. I don't want to, you're not going to be penalized because you no longer have that. You have that history. That history stays with you, that you paid it, hopefully, on time as you did. Whatever went on in the past doesn't go away. I think the way to put this is, don't go out and buy another car just so you can have a car loan and show off. That is not the kind of thing that, anybody needs to do. You just need to have some activity as far as credit goes. But 100%, more power to you if you've paid off your car. You don't want to take on a new one. And no, your credit score we don't see that with that kind of a debt. It's not a revolving debt. It's an installment debt that you paid off over time. I don't see scores going down because somebody has paid that off.
Yeah, the other question we have, it's more a mortgage question. There will be, I believe it's better that you reach out either Patricia or myself to answer that, because she's asking what are the best type of mortgage to apply for. Have an 825 FICO score and save up $15,000. I guess it's harder to answer here, so please reach out to us and we can give you fully information about that.
Yeah, the mortgage can be tricky with a lot of different factors, right? So yeah, Elena can talk to you about that, or I can. But sounds like you've done yourself a lot of good if you've got that 825. That's excellent, gold star, and $15,000 is great for the savings. So those two bits are in good shape, but we probably need to talk about the broader picture.
Yeah.
Yep, definitely. All right, so I think we've done pretty well time-wise.
Yeah, thank you very much for all for coming to our webinar.
Yep, and as we said, you have our contact information. Oh, okay, well, I don't hello. You have our contact information, and we will happily follow up on any questions afterward. Good night, everyone. Thank you.
Thank you, everyone.